Get back now to this week, though, because really we have been defined by renewed fears around Europe, particularly Spain, and of course the China stuff. But let's focus on Europe. Major U.S. companies have about 20 to 30% exposure to the Eurozone, but abandon Eurosis for a moment. Our next guest says America may ride to the rescue. Joining us now from London, Alpesh Patel, principal of Praefitium Partners. Alpesh, thanks very much for joining us. We got a big week next week with Spain. Obviously, Italy was okay this week with some of their auctions, but we look at the swaps. They are the widest they've ever been on Spanish debt. How concerned are you about Spain? Alpesh, are you there?
I am. Sorry, I had another voice in my ear.
I have voices in my head all the time, Alpesh. Do not apologize. My question to you is about Spain. Big bond auction next week. Swaps are widening. How worried are you?
Actually, I'm not worried in the least, and I'll tell you why. First of all, the reason that the swaps are widening is partly a reflection of strength in the German economy, which is by far the most largest and strongest economy in the EU. And let's put it all into context. The Italian bond auction went away fine this week. The German bond auction went away fine. And Spain's auction went away fine, and yields are only at around 6%. If they stayed at 6%, then by 2016, their debt to GDP ratio in Spain at these higher yields would still be lower than what America's debt to GDP ratio is today.
Okay, then let me follow up with this. What yield on, let's call it a 10-year Spanish bond, would concern you? What is that magic number of possible lack of funding that you would be worried about, Alpesh?
The figure actually relates not so much to the yield, but what would tip them over 90% debt to GDP. And the reason 90% debt to GDP is the magic figure is because that's the figure at which economists say it starts hurting the Spanish economy. At the moment, Spain's debt to GDP at the end of last year was 67%, a mere 67%. In fact, the whole of EU is lower as a debt to GDP ratio than the United States. So what yields would knock them over 90%? It's not going to be the yields which are going to be a problem. They'll probably hover around these kind of levels. What it would be is if all Spanish banks wrote off 50% of the real estate valuations that they have on their books, and you had to capitalize the banks to that equivalent, which is about 88 billion euros or 8% of Spanish GDP, that would then knock them over the 90% debt to GDP ratio. So it's the write-off on real estate valuations. And guess what? Spanish banks aren't stupid. They're not going to mark to market on real estate valuations. They'll just carry it forward, because what matters is credibility.
You know, Alpesh, Spain hasn't had the option of devaluing its currency beyond what it can do within the euro. That's forced internal devaluation. Would it not have been better from the get-go if countries like Spain had been able to cut wages significantly to prevent some of their unemployment?
There's a lot of things which it would have, could have, should have. Actually, they still have the option for, as you say, internal devaluation, which means wage cuts. The problem in Spain has been that if you take 2005 as a base year, then Germany has actually seen wage cuts of 5% across the board, which is why Germans are competitive and exporting their way out of their problems at the moment. Whereas in Spain, salaries are still the same. Instead, you've seen 23% overall unemployment in Spain because they've made people redundant instead of just easing off some of those salaries. If they cut wages by 4 to 5%, you'll see less social unrest, and you'll see greater employment. That's what the government needs to get the message out to employers, is don't make people redundant, just ease back on their salaries instead, so everybody stays in employment, continue paying tax, and you don't get the shock of unemployment and the social unrest.
Great context, but let's bottom line it, help our viewers make some money. How do you trade what's going on in Europe?
Well, there's a country in Europe we haven't mentioned at the moment. The one I'm speaking from is the United Kingdom. 56% upward revisions of corporate forecasts, earnings forecasts over the last quarter. Upward forecast. That's far better than any other EU country. In other words, we're lagging behind in terms of actual earnings and what's forecast. So there's some money to be made in UK companies, not least because the FTSE 100 is trading at an earnings multiple of only 12. The other one, of course, is your own economy. The United States, you're seeing some growth, which is fueled, albeit by increasing debt further down the line, but we'll worry about that in 3 to 4 years. For the moment, you've got GDP growth, which means those corporate earnings, due to the fact that you've got wage wage flexibility, which is causing earnings and profitability to bump up because you're not paying the kind of salaries you normally would under normal economic circumstances, means that those U.S. stocks are also good purchases.
Alpesh Patel, have a great weekend, bud. Thanks for joining us. Know it's late there. Appreciate it.